Hello everyone, welcome to Demand Supply Trading Practical Session number 25 for the year 2025. Myself Rajiv Kakar, and today is Sunday 22nd of June 2025, and before we move ahead with the session, let's get done with the basic formalities. So make sure you people go through the disclosure, which talks about the representation, risk disclosure, risk involved in the market, and also about the copyrights. Now, we do have a channel on Telegram where we keep updating you with content related to demand supply trading methodology. So in case you've still not joined this channel, there are a few different ways you can join it. First one is you can scan the QR code, which is on your screen. Next, if you look into the description, you will also be able to find the direct link. You can click on that and you can join this channel. And thirdly, once you visit our website, which is rajivkakar.com, or you can use the short URL, which is sk.coach. Just give me a second. Let me quickly show you. Alright, so once you visit our website, you can just scroll down on any of the pages, and at the bottom you'll have the option which says join Telegram channel and the join now button. You can click on it as well to join the Telegram channel. Now also these live sessions, we keep updating you when these sessions are getting scheduled on the Telegram channel. So yes, you have an option which is you can subscribe to our channel, which is where once the session starts you'll get a notification for it. But if you are on the channel, then you'll get to know the date and the time well in advance. All right, so now that we are done with the basic formalities and the Telegram channel, let's talk about today's session. So today's session is practical application of demand supply methodology. So our demand supply course used to be a paid course. Now it is available 100% free. You can learn the complete methodology, theory as well as the practical sessions. Everything is available 100% free. So what happens is when you learn the methodology through our lessons, you basically learn it theoretically, but unless and until you see some practical examples, at times it's not very easy to implement it. And that is what we do in these practical sessions. We take some examples, and to those examples we apply the complete process so that we can understand how to plan trades very mechanically and rule based. Now, the best part about these sessions is that we are not looking into something which has already happened, because like I always say, that's a piece of cake, moves which have already happened. It's very easy to apply some indicators, oscillators, and then justify, why we could have been a buyer or a seller on that particular move. But the real beauty or the real challenge is when you are doing the analysis well in advance, and that is what we do in demand supply methodology. In demand supply, we always pre-plan the areas where we would like to be buyers and sellers, and that is how I also conduct these practical sessions. We identify our areas well in advance, and whenever in the future prices they revisit those areas of demand and supply, that is the time the trades they get triggered. And since we are doing the analysis in advance, it does not mean that I just share the analysis with you and then we forget about it. Whatever analysis we do, whenever those trades they get triggered, we also review them, and that helps you see both the before as well as the after. And since you're able to see the before as well as the after, it helps you build confidence in the methodology. All right, so now to feel comfortable with these sessions, there are also some prerequisites, and if you complete those prerequisites, these sessions will be much more easier on you. So let's understand what these prerequisites are. The very first one is the Trading Essentials course, which is optional for someone who already has a very good trading background. And if you have been trading, let's say, for a number of years, so if you want to skip the Trading Essentials course, you can definitely do that. Again, like I said, provided you have a very good trading background. But if you're starting as a fresher, then I would highly recommend to start with that Trading Essentials course. Now, how do you get access to the Trading Essentials course? Very simple. Once you are on our website, under services, you'll have the option which says courses. Click on it. And under courses, you can see the very first one is Trading Essentials. Click on it. And then you have the course in English and Hindi. So whatever language you're comfortable with, you can click on that. You can visit the playlist of that particular language, and the course is designed for you in a very systematic way. You have lesson 1, lesson 2, lesson 3. So just go through all the lessons, and once you have covered all the lessons, That basically covers your Trading Essentials course. Again, no sign up required, no registration required. Clicking on these buttons will give you immediate access to the course content. All right, so that's your very first prerequisite, which is the Trading Essentials course. Now, once you're done with Trading Essentials, the next step is to learn demand supply methodology. Now, how can you do that? Again, on our website under services, when you go to courses, you will see the second option is demand supply trading. Click on it. And here also the course is available in two languages, English and Hindi. So wherever you're comfortable with, you can click on that and get immediate access to the playlist. Go through all the lessons. I guess it's about 15, 16 lessons. So once you go through all the lessons, that basically covers your demand supply trading methodology. Now, what happens is when you go through this course content, you basically learn the methodology theoretically. And like I said, unless and until you see some practical examples, at times you don't get a very good understanding of how it has to be implemented. So that is why we also provide you access to the recording of the previous practical sessions. So when you click on practical sessions, you can watch the past sessions, again, available in both languages, English as well as in Hindi. The current archive is almost close to 1.5 years of recording. So a lot of content is available to you. The more number of sessions you'll watch, the better you'll start having the understanding of how to implement the methodology. Plus, on top of that, so these would be the recorded sessions from the past, but every weekend I also do live practical sessions like I'm doing right now. So you can also join these live channels, live sessions. And the best part about these live sessions is that whatever doubts, questions, queries you have, you can put it in the chat box. So what I do is at the end of the session, whatever your questions, queries are related to demand supply methodology, I help you with them. So yes, if you have some questions, queries, you can start putting it into the chat box. At the end of the session, I'll take those questions, queries, and I'll help you with them. All right, so that basically covers the Trading Essentials course and the demand supply trading course. After that, during the live session, you will see that I use two documents. The first one is the rule book. The second one is the flow chart. And these two documents help us plan trades very mechanically and rule based. Now, how do I get access to these two documents? Again, very simple. On our website under services, you have the option for downloads. Click on it. And you can see the first one is the rule book. The second one is the flow chart. You can click on the download buttons and you'll have your rule book. And you will also have your flow chart. Right. So like I was talking about that we do the analysis in advance, and if any of the examples that I share with you, they get triggered, we start with the review of them. So today we do have an example which is pending for review. So let's start with the review and then we'll take today's example. Now this is this example is from session number 24, which we did the last time. So the last session was session number 24, which was 15th of June. And when we did the analysis, this setup had a score of 10 out of 10, which made it as a high quality trade setup, and also a score of 4 out of 8, which also made it as a high probability setup. And we know that high quality, high probability can be done as type 1 trades. So this was qualified as a type 1 trade for us. Now the next thing is when the prices are almost about to enter the zone, we also have to check how's the reward to risk ratio, because we understand that every trade is not going to be a profitable trade. So we need to ensure that we have at least a 2:1, and only if we have a 2:1, we will be participating. In fact, if you're planning trades which are overnight trades, then you should definitely be looking at a 3:1. But what I'll do is, based on my experience, I'm okay with even foregoing for a 2:1 for an overnight trade. But otherwise, my recommendation is definitely for a 3:1 initially. But as you start having more and more experience, if you want to shift to 2:1, acceptable. So yes, to check your reward to risk ratio, what we'll do is we'll change the indicator settings and say I want all structures of demand and supply, so that I can see where are the opposing supply areas, because if you're buying at demand, your supplies will be your target. So if you're looking at your supply areas, you can see we do have a supply area right here, which is already tested. So since it is a tested zone, it is of no concern to us. The next supply area is right here, which is again tested once, twice, thrice. So it has been tested multiple number times. So again, as a rule, we do not take tested areas as our target. We only look for fresh areas as our target. And the nearest fresh area is somewhere around here, which is showing us a reward to risk ratio that is 1:1, 2:1, 3:1, 4:1. 5:1, probably close to 6:1. So reward to risk ratio is not a challenge. We definitely have a really nice reward to risk ratio of 6:1. which definitely makes it as a valid trade for us. So yes, on the 20th of June, right? So on the 20th of June, prices came into our zone. We did the analysis on 15th, came into our zone on the 20th. So yes, as of now, this will remain as an open trade for us with a target, which is somewhere around here. That is showing us about a 6:1. So we will continue with this for the next few days unless and until we get an exit on it. As of now, we haven't got the opportunity even to make it as a break-even trade because we just got our fill. Once it reaches our 1:1, that is the time we can revise our stop loss to our break-even point. So currently, this will remain as an open trade, no modifications, and that basically takes care of the example which we analyzed the previous session, and it got triggered during the week. So now just give me a few seconds. Let me bring up the example for today's session, then we'll start with the analysis. All right, so now that we are done with the analysis, sorry, not the analysis, the review of the example that we shared the previous session, let's start with our example for today's session. So like I always say, trading has to be very mechanical and rule-based. Why it needs to be mechanical and rule-based? I have explained this in a video. The title of that video is How to Start Trading. You will be able to find the link in the video description. So just go through that video. It's a very, very important video to watch and understand why we need to be very mechanical, why we need to be very rule-based, and what process we should follow when we start learning trading, right? So do go through that video. The process I've explained in that cannot be bypassed. You cannot skip it. You'll have to go through that process, if not once, maybe twice, thrice, but yes, you'll have to go through that process to start becoming more of a rule-based trader and less of a emotion-based trader. All right, so since we need to be rule-based, we need to create something which is called as a trade plan. Now, the challenge is if you've just started learning trading or you've started learning a new methodology, it's not very easy to create a trade plan from day one. So that is why what I've done is I have created a trade plan for you, which is more of a conservative approach. With time, with experience, yes, you can definitely make modifications to it, but at least you do have a starting point using which you can start planning your trades. So what is our step number one whenever we start planning our trades? Step one is we need to define our trade purpose. Now, what do we mean by trade purpose? Trade purpose basically implies the expected duration of the trade. And the duration of the trade is from the time you enter the trade to the time you exit the trade. Now, when I'm talking about the exit can be the target, the exit can be break even, the exit can be the trailing stop loss, the exit can also be the stop loss, any kind of exit. So again, by exit, we do not mean only profit exit. It can be profit, it can be break even, it can be a small profit, it can also be a stop loss. So why do we need to start with the trade purpose? And the reason for that is when we do our analysis, the charts that we use, they are time-based charts and we have a number of time frames available to us. So the very first challenge is that since we have so many time frames available, out of these a number of time frames, which time frame should I be using for my analysis? That's the very first challenge. And to overcome this challenge, we do not start by randomly selecting any time frame. We again go with a very mechanical approach, and that mechanical and logical approach is that the longer I want to be in the trade, the bigger the time frame I should be using for my analysis. And similarly, the smaller I want the duration for the trade, the smaller the time frame I should be using for my analysis. So what I've done is I have divided these trades into 4 different purposes. We call them as the hourly income, daily income, weekly income, and monthly income. Hourly income implies a trade where my expectation is that this trade can last for an hour or few hours. Daily income, a trade which can last for a day or few days. Weekly income, a trade which can last for a week or few weeks. And monthly income is a trade which can last for a month or few months. Now, when you're trading markets which are not 24-hour markets, then what happens is whenever the market opens, I'm pretty sure you people would have experienced some of the symbols they gap up and some of the symbols they gap down. Now, because of this gap up, gap down, what can happen is if you get a gap in your favor, you might get profit, which is bigger than what you were expecting on that trade. But if you get a gap against you, you can also lose more than what you were willing to lose on that trade. So we understand that whenever we hold a position overnight, we have that add-on risk of a gap which cannot be avoided. So that is why my recommendation to all of you is if you're trading markets which are not 24-hour markets, then initially your hourlies and dailies should be strictly intraday trades. Don't keep them overnight and take that unnecessary overnight gap risk. Now for weekly monthlies, anyhow, we are not expecting to get the exit the same day. So here we have no choice. We'll have to keep these positions as overnight positions. But that does not mean that for weekly, monthlies, we cannot have a gap against us. It can still happen. But since we are leaning against some bigger time frames, the probability definitely reduces. But as you start having more and more experience, you start building confidence in your analysis. If you want to include daily incomes into overnight trades, that can definitely be done. But initially, we'll avoid that as a risk management rule. So my step number one was I need to define my trade purpose, and let's assume I opted I want to plan monthly income trades. Now, once I have selected my trade purpose, what is going to happen? From the rule book, I'll get to know what time frames I should be using. So if you go to page number 28 on the rule book, we start with our topic, which is multiple time frame analysis, because demand supply is not based on single time frame. Demand supply is based on multiple time frame analysis. Now, what are the multiple time frames we use? We use a minimum of 4 different time frames, and we call them as the high time frame HTF, intermediate time frame ITF, lower time frame LTF, and the refining time frame RTF. Higher time frame is used for demand supply curve analysis. Intermediate is used for trend analysis. On the lower time frame, we identify our areas of demand and supply for our entries and exits. And the refining time frame can be used for multiple purposes like fine-tuning the zone, different kind of entries like your type 2, type 3 entries, or in case we need to apply some additional rules, that is also where this time frame can help us. Next, what are the 4 different purposes of trades? We have already talked about it. What is HIT, DIT, WIT, and MIT? So now the question comes that for every purpose of trade, what will be my 4 different time frames? And we get the answer from this table. Like in this example, I want to plan monthly income trades. So now I know that as a monthly income trader, my time frames will be monthly, weekly, daily, and 60. Monthly is the higher time frame, which is used for curve analysis. Weekly is the intermediate, used for trend analysis. The lower time frame is daily. That is where we get our SETS from. SETS stands for stop loss, entry, target, and size. And in case we need to use the refining time frame, then my refining time frame will be the 60 minutes time frame. So as soon as I select my purpose of trade, I get the clarity to what time frames I'll be using, plus what is the purpose of each and every time frame. Now, minded, this table, which is on page number 31, is specifically for the NSE market, because this market is only open for 6 hours and 15 minutes. If you are trading markets which are open for longer durations, like your commodities, forex, cryptos, then you can look into the table which is on page number 32. But since I'll be taking examples from NSE, I'll be referring to this table and I'll be using these time frames. So as soon as I'm done with my step number 1, I said define my purpose of trade. From the rule book, I get to know what time frames I'll be using. Plus now I also know what is going to be the purpose of each and every time frame. So my challenge number 1 is taken care. Now the next challenge is, yes, I do know my time frames. But on NSE, we have over 2,000 companies listed. So humanly not possible that every day I sit and analyze 2,000 companies. So what we need to do now is we need to have a process in place which can help me get a smaller list out of a very big list. Because if you have a small list, you can do your analysis almost every other day. But if you have to go through such a big list, it's not an easy task. So how do we get a smaller list? For this, we use certain computer programs which are called as scanners or screeners. And the way these computer programs, they basically work is that we input our conditions into it, that these are the conditions I'm looking for. And those conditions can be based on either conventional technical analysis or fundamental analysis. And based on those conditions, we get a smaller list of symbols, which it shortlists for us. So if you do a Google search, you'll be able to find a number of scanner screeners, 100% free, using which you can get a smaller list. But the challenge with all those scanner screeners is that those scanner screeners are either based on conventional technical analysis or they are based on fundamental analysis. They are not based on demand supply trading methodology. So what I've also done is I have created 2 tools. One is called as the demand supply zone alert and the other one is the demand supply zone screener, which helps us shortlist symbols based on demand supply zones. Now, if you want to understand how these tools, they basically work, you can click on these and it will take you to the product page. Otherwise, once you're on our website, you can also do something like this. Under services, go to TradingView indicators. And here you can see we have the alerts and the screener. You can click on them. And on the product pages, you'll have the link to the walkthrough videos. Just go through the walkthrough videos. They will help you understand how these tools, they basically work. But just to quickly help you understand, so what alerts basically does is that you give a list of symbols, that these are the symbols I am interested in monitoring. So what will happen is if a demand zone or a supply zone gets formed on any of those symbols during the live market, it will immediately notify you that you have a formation of a demand area or a supply area. So that's what alerts basically does. And what Screener basically does is, again, you provide your list of symbols, and then you say, okay, out of these symbols, whenever the current candle is almost about to enter a demand area or a supply area, or maybe, I want out of these symbols only the symbols where prices are already in the demand area or the supply area, shortlist for me. And that is what the Screener does. So that's the difference between the two. Again, alerts will tell you about symbols where the zones are getting formed during live market, and Screener will help you shortlist symbols where we are about to enter the zones or we are already in the zones, right? So that's the difference between the two. So yes, these are two scanners using which you can shortlist. And again, like I said, the walkthrough videos are available. You can go through those walkthrough videos to understand them better. And again, the process can also be as simple as, because I want a small list, I will only be maybe analyzing my Nifty 50 stocks, or I have my own favorite list of symbols which I want to analyze every day. So choice is yours how you want to get that small list for you. But once you have that small list, we are ready for the next step. And what we need to do now is we need to analyze them one by one. And out of this, whatever matches with your trade plan might be a trading opportunity. Whatever doesn't match with your trade plan, you simply skip it. Now, very, very important, remember, irrespective what process you're using for shortlisting these symbols, you can never blindly buy or sell these symbols, right? Whatever is getting shortlisted for you, because the job of the scanner or screener is not to tell you what you need to buy or sell. The job of the scanner is to help you identify symbols where you might have an opportunity which matches with your trade plan. So again, remember, scanner screener does not tell you what you need to buy or sell. It only helps you identify symbols where the probability is very high that you might be able to find something which is in sync with your trade plan, right? So that is what the scanners, they basically do. So now once we have that list, let's assume the very first one was ABC. So what we need to do now is, on ABC, we need to go to the lower time frame. So the question is, what is my lower time frame? We got the answer from our step number 1, that as a monthly income trader, our lower time frame was daily. So we'll go to the lower time frame and we need to identify zone. And by zone, we mean any of these 4 structures. It can be a drop-based rally, rally-based rally, rally-based drop, or a drop-based drop. Now, the next amazing news for all of you is that we do have a indicator which automatically identifies the demand and supply areas on the chart. So now, that manual process where I have to identify where are the demand areas or the supply areas is handled by the indicator. And we offer a 100% free 7 days free trial of that indicator. So if you have still not taken the trial, you can do that. And the way you can take the trial is visit our website. Under services, you'll be able to find TradingView indicators. Click on that. And you can see the very first one is the zone indicator. So just click on the zone indicator. And then you can see on the page, you'll be able to find 7 days free trial. Click on it and it will take you to this page where this form will take you probably less than 30 seconds. So all you need to do is select how did you hear about us. You have few options. You have to provide your full name, you have to provide your email address, and then you have to provide your TradingView username. Now, in case you don't have an account on TradingView yet, you can click here and you can create a 100% free TradingView account. And once your account is created, then you can share your TradingView username in this column. And if you already have a TradingView account, then you can click here, you can visit your TradingView profile, identify your TradingView username and provide it. Now, this is very, very important that you provide your correct TradingView username, because if you have provided an incorrect TradingView username, it will not get activated for you. It will get activated for whoever that username belongs to. So always ensure that you double check that you're providing the correct TradingView username, and then just simply submit it. And once you submit this form, within 24 hours, it will get activated for you. And upon activation, you'll get a notification on TradingView that now you have access to the indicator, and then you can try it for free for 7 days. So again, because now everyone has access to the indicator, whatever analysis we'll be doing based on the indicator, and that will also help you see how beautifully the indicator works and how easy it makes the process for us to do our analysis. So here you can see I have the chart. So let's assume that's the very first symbol that was shortlisted for me. And once I apply the indicator, you can see I don't even have to identify the zones. It is automatically identifying where are the demand areas, where are the supply areas. So we can see the nearest demand area we have is right here. So let's draw this demand zone. second. So now my step number 3, which was to identify the zone, is done. The indicator automatically identified the demand area for us. So do we have a zone available? The answer is yes, we do have a zone available. Now, once we have identified the zone, does not mean we trade it blindly. The next step is to qualify it. And for qualification, we have a 2-step process. In step 1, we'll qualify it based on certain conditions. And in step 2, we'll qualify based on the booster scoring. So the very first condition we'll check is that can this zone be a case of level on top of level? And how do we verify that? It's a very simple concept. If you have an intermediate time frame zone, and the same intermediate time frame zone divides into multiple zones on the lower time frame. So again, when the intermediate time frame zone divides into multiple zones on the lower time frame, we call it as a case of level on top of level. So what we understand from here is that to be a case of level on top of level, the first criteria is my lower time frame zone has to be completely inside the intermediate, which we call as a coinciding level. So if we have a coinciding level, we might have a case of level on top of level. But if we don't have a coinciding level, it cannot be a case of level on top of level. So let's verify that the zone we have identified, does it coincide with any intermediate time frame zone? And in this case, our intermediate will be the weekly chart. And once I go to the weekly chart, you can see wherever my lower time frame zone is, we don't have any weekly zone, which means it is not a coinciding level because my lower time frame zone is not coinciding with any intermediate time frame zone. And since we don't have a coinciding zone, it cannot be a case of level on top of level. So level on top of level not applicable. Now this zone is not because of a gap, therefore gap rules will also not apply. Now talking about pivot and non-authenticity, we always consider a drop-based rally or a rally-based drop by default as a pivot or a non-authentic zone. So definitely it's a pivot or a non-authentic structure. You can see it's a drop-based rally. So what we need to do now is we need to qualify it based on the rules of pivot and non-authenticity. Now I have given you 2 different ways to do it, but you're not restricted only to these 2. This is, like I said, just a starting point. With your experience, you can always modify whatever suits you, right? But the ones which I've given is right here, PIVOT. You can see the aggressive rule says that before applying the boosters, make sure the move from the zone was able to violate at least one opposing zone on the intermediate time frame. So here you can see when we got this move to the upside, did it violate any intermediate time frame zone? So if I look for supplies here, you can see that the move from the zone did not violate any supply. So if I just do a candle replay from here, because this is where the zone was formed, you can see that there is no supply here. The nearest supply is right here. So unless and until this will get violated, it will not satisfy the condition of the aggressive rule, right? So going with the aggressive rule, we do not have a qualified zone. Now, if we talk about the conservative rule says before applying the boosters, make sure that the move from the zone was an impulsive move on the intermediate and we have an authentic zone on the refining time frame. Now, if I'm applying the conservative rule, you can see the first condition was on the intermediate time frame. You can see I'm already on the intermediate time frame. We need an impulsive move. So you can see this was my last pivot low, and from here when we got the move, it definitely breached this, sorry, not last pivot low, it was the last pivot high, right? It was definitely able to breach this high and create a new high. So we definitely have an impulsive move. So my condition number 1 is definitely there, that we need an impulsive move, and we can see that impulsive move. And the second condition was that on the refining time frame, I need to see an authentic zone inside of it. Authentic zone would mean that I need a rally-based rally, which in this case is missing, right? So let's wait for a few seconds. If I want the indicator to load faster, I can say only plot on the visible data. So now you can see it loads much faster. So you can see inside of this, we don't have a rally-based rally structure. So the fact is, irrespective whether you are applying the conservative rule or the aggressive rule, this would not qualify for us. So now the question is that if this is not qualifying, why am I sharing this as an example for you? See, the fact is, like I already said, the rule book which we are sharing as of now, or the trade plan I have shared with you as of now, is the most conservative trade plan. Now the problem is, because we are following the most conservative trade plan, at times it is not possible that for every session I am able to find an opportunity which matches with it, right? So today there was nothing which was matching with that conservative approach, so I had no choice to pick something aggressive. Now, why is it aggressive? We'll talk about it as we move forward. But yes, if you are a very conservative trader and you're using exactly the rules that I've given you in the rule book, then this trade setup is not a qualified trade setup for us, right? So the fact is, if we are applying these rules, as soon as we reach pivot and no authenticity, this will get disqualified for us. But we'll move forward and we'll talk about it, why as an aggressive trade it is still okay with me. So yes, for a conservative trader, this is where it ends. This is not a qualified setup for you. For someone who is aggressive, we'll move on to the next step. So unstable equilibrium not applicable. So after applying all the applicable rules, is the zone qualified for us? Again, using the pivot nor authentic, the most conservative approach, this is not qualified. But ignoring it, I'll say, okay, yes, it is qualified for me. So now, since I have a qualified setup, ignoring pivot and nor authenticity, let's apply the boosters now. So the very first one is freshness, gets a score of 3. Talking about the strength, currently you can see the indicator is identifying as a follow through pattern. So I would like to check, does it also get identified without the follow through? So this is definitely an explosive move. Can you see when I disabled that I don't want follow through pattern, it is still getting identified for me. So that tells me we have an explosive move, gets a score of 2. Talking about time at the zone, we have 2 candles in the basing, gets a score of 2 again. Reward to risk ratio, will take it as an assumption. Now talking about the location, you can see we just hit a monthly demand area. That is where we have started getting reaction from. So we will get a score of 2 for location because we are at the best location. Now at best location, trends, they technically become irrelevant. It doesn't matter whether you are in an uptrend, downtrend or sideways. All of them can be traded with a score of 1. Though currently you can see the indicator is telling me we have violation of 2 demand areas, and violation of 2 demand areas will make it as a downtrend, but we can still give it a score of 1 because we are at the best location. Move from the zone, we need at least 4:1. So do we have a 4:1 move as of now? You can see we only have about 3:1, so we'll give it a score of 0. But yes, prices can eventually move up and then come back into the zone, which can shift it to a score of 2. It is not a case of level on top of level. It is not even a coinciding level. And talking about trap, let's see, do we have something which might make it work like a trap? So if I take a horizontal line and then I start pushing it up, trying to identify area where prices have been bouncing over and over again. So if we reach somewhere around here in the past, you can see that this has worked beautifully like resistance. In fact, we can push it a little higher. Then you can see it almost working like resistance here, almost like support. Again, working like resistance, almost like support, working like support. So we do have a pretty clean area of support and resistance. And the zone is sitting right below it, which can make it work like a trap, right? So yes, I can give it a score of 1 for it. So if you look at the overall scoring, we have a score of 10 out of 10 for quality with the assumption of reward to risk ratio, and 4 out of 8 for probability, which makes it as a high quality, high probability setup, and high quality, high probability can be taken as a type 1 trade. So now coming back to the question that why did I still plan this even though with the rules of pivot and non-authenticity, this was not qualified for us. The only reason is the location is supporting us. You can see we came into a monthly zone. We already started getting a move to the upside. In fact, this month was very, very bullish, and that is where the zone was formed. And that is the only positive factor which I can see here if I still want to plan this trade. So again, like I said, if you have structure of pivot and authenticity, we are trying to add some positive factors. So that was one positive factor which I could see, and that is why I call it as an aggressive trade. Now, why am I calling it as an aggressive trade? Because if you think about it, based on the booster scoring, I am allowed to take this trade. It's just that based on my trade plan, this was not getting qualified for us. So a trade which we are allowed to take based on the booster scoring, it's just that it does not match with my trade plan, is what we call as an aggressive trade. Why? Because I know now I'm trading something which is not in my plan. That is the reason we are calling it as an aggressive trade, right? So as an aggressive trade, this is still qualified. Nothing wrong with it. But yes, now if you want to be, let's say, a little bit on the conservative side. You can say, okay, even though it is a type 1 trade, let me do it as a type 2 or a type 3 trade because it does not match with my trade plan. So that is where you can be a little on the safer side. So yes, after applying the boosters, we got to know this is a type 1 trade. Now, no matter how high the quality or the probability, any trade can be a stopped out trade. So we need to be ready for the worst case scenario, for which we'll do a proper position size calculation. Now, whenever the prices are back, we'll have to re-verify because the markets are not static, they are dynamic. Conditions are changing almost every other second. So before entering the trade, we need to ensure that it is still qualified based on our trade plan. If the answer is yes, we place our order based on the entry type. And once you have got your entry, the last step is your trade management. Like we saw in the example from session number 24, we have already got the entry now. We didn't get any opportunity to do trade management. So as that trade progresses, if we get the opportunity to manage it, you'll also see how trade management is done. And the rules for trade management is that 1:1, we make it as a break-even trade. And after that, if we get the opportunity to trail onto it, we start using our trading stop loss until we get the exit on it. So this is how we plan trades, very mechanically and rule-based. And if these sessions are helping you plan your trades better, then do like the video. And if you're not subscribed to my channel, do subscribe so that you get notified whenever I do these sessions. And the most important part, I'm pretty sure you people also understand that a lot of people are struggling with trading, and they are looking for resources from where they can learn the right way to trade. So help spread the word. You can share my course content videos, you can share links to these live sessions. You can share the link to the trial of the demand and supply zone indicator with your fellow traders, be that your friends or family members who are into trading, or if you are part of some trading group, do share on those trading groups as well, so that more and more people can take advantage of it. Because like I said, the course is absolutely free, so it's not that they have to pay something for the course. So again, when you have free content available to you, why not learn from it? So the more you'll share it, the more people will get advantage of it. And yes, that might also help a lot of people avoid some huge losses. Now, coming back to the last, the last area of this session where I take your questions, queries. Before I do that, I would also like to add that a feedback which I was getting from you people was that yes, we do have a live session where you take the questions, queries, but what if I don't want to ask my questions publicly? That was concern number one. And second concern was that yes, even if I'm okay with asking my questions publicly, what if I want to share my analysis, which cannot be done in the YouTube chat, right? So what is the alternative? So we have come up with an alternative which is called as one-to-one session. So if you feel that you need a one-to-one session with me, you can schedule it by coming to our website. On the top right corner, you will find this option one-to-one. Click on it, and there are two options available to schedule your sessions. One is your voice call. So if you feel that on a voice call you can ask your questions, queries, and the answers will be helpful to you, you can go for a voice call. But if you feel that you need to share your screen as well, for which you want to go for an online meeting, that option is also available there. So these are the two ways where you can schedule a one-to-one appointment, just in case you're not comfortable in asking your questions, queries during the YouTube live session, or maybe you want to share your analysis, which cannot be done during the YouTube live session. All right, so let's see what questions, queries we have for today's session. Let's see. So according to your experience, which pattern's reversal or continuation is more powerful, or which pattern works well in trending or sideways market? See, again, at the end of the day, if you go through the n number of practical sessions I've taken, you will see that it's always a mix of both kind of zones. Both kind of zones, they have their own pros and cons, right? And a very simple example would be, let's say if we take example of two demand areas, right? We definitely consider a drop based rally as a pivot or an authentic zone. But if you talk about a rally based rally, can you see a rally based rally always precedes with a rally? So what if this is not located at a very good location? So that is why we check the complete picture. So irrespective what kind of a pattern it is, as long as it is in sync with your trade plan, they are tradable for us, right? So I will not give any one of them more weightage. If we have a specific kind of a pattern, we also have some conditions attached to it, and if those conditions are satisfied, it is a tradable setup for us. So again, I'll not give any particular setup lower or higher weightage. I'll say any zone which matches with my trade plan always gets the equal weightage, right? That is how it has to be. How do I get the Excel sheet, like the probability scoring? So again, the Excel sheet which you see that I use during the session, that is not available for download, and the reason for that is here you can see I have to give the scoring manually, right? And if you don't know how to give the scoring manually, you can make a mistake. So I have a better sheet available. So if you go to the services and go to downloads, here you will see that you have a smart Excel sheet. So what happens with the smart Excel sheet is that you now just have to select the conditions, and based on the conditions, the scoring is given automatically. So this is a much more advanced sheet, but the thing is, once you use this sheet, you will see that it's available in a horizontal way, right? So since it is horizontal, you're not able to see everything just at a glance. So that is why I use it manually, because I know how to give the scoring correctly. But for you people, use the smart Excel sheet, which will ensure that you don't make any mistakes while doing the scoring. So as long as you're giving the conditions correctly, the scoring will automatically be generated correctly in that smart Excel sheet. All right. But it's a higher time frame. Monthly demand zone is tested zone. See, again, if you talk about the curve analysis, right? You might be talking about the curve analysis, where when I'm doing the curve analysis, the monthly zone is already tested. I'm still using it for my curve analysis, and I definitely do that. See, again, there are two reasons for it. Reason number one, the bigger the time frame, the higher the weightage, right? So what you will see is that on bigger time frames, prices can hold for multiple tests. The second reason is that on bigger time frames, now if I'm only looking for fresh areas, you can see the first fresh area is right here. So let's assume if I'm looking for fresh area, I'm still somewhere around here, and I am still waiting for prices to move maybe another 50% down, which might not happen, right? Yes, it can happen, but again, fresh areas can be really, really far away, right, in terms of percentage. So those are the two reasons, that the bigger the time frame, the higher the weightage. So that is why when I'm planning monthly income trades, in fact, even for weekly income trades, I am comfortable in using tested zones for the curve analysis. And when it comes to lower time frames, let's say if I'm planning an hourly income trade, I will never use a tested zone for the curve analysis. In fact, if you go through the rule book, yeah, I think I've also given it in the rule book. I'm not sure whether this is given in the rule book or not. I mean, rule book definitely says always use a fresh area. So here it is. Can you see curve rules? For HITs, always use fresh areas. For DITs, yes, you should prefer to use fresh areas. But if you are an aggressive trader, you can use tested, as long as they are in sync with the weekly, which means it is also a weekly zone. It is also a daily zone. And for weekly monthlies, yes, if you want to use tested zones, it can be done, because like I said, the bigger the time frames, the higher the weightage. So you can see that is available as a curve rule. But yes, the smaller the time frames, then I'll definitely be more inclined towards using only fresh areas, even for the curve analysis. For the bigger time frames, I'm very comfortable using tested areas, because like I said, already two reasons. One, bigger the time frame, higher the weightage. Two, fresh zones can be really, really far away, which might make you miss a lot of trades. All right, so that covers all the questions, queries we had in the chat box for today's session. And that also brings us to the end of today's session. Next, I'll be seeing you next weekend. But before we end the session again, I'll request all of you that if you are part of some trading group, or if you have any friends, family members who are into trading, do spread the word so that more and more people can take advantage of it. And okay, I just got another question. Let me see. I just joined the session for the first time. So tell me where to start to use your indicator, and is it for option intraday trading or for stock? See, again, okay, let's start with first, how should I be starting, right? So if you just join, just watch any of the practical session from the starting. That is where I tell you step by step what you need to do. So it is already covered in all our practical sessions. So even if you watch the today's session from the starting, you'll get to know step by step what needs to be done. Second, if you're talking about, let's say you want to plan an options trade, an option trade will again first start as a demand and supply setup, right? I'll identify where are the demand areas, where are the supply areas, right? Once I have identified this, then what you're doing is you're simply substituting taking that trade in cash or futures by options. And that is where then you'll have to apply the option strategy. So again, if I have identified a demand area, let's assume I'm expecting that from this demand area prices can move up. So I'll plan an option strategy, which will be a directional strategy, a bullish directional strategy. Similarly, if I see a supply zone and I'm expecting prices to move down from there, I'll plan again a directional strategy, which will be a bearish directional strategy. Now let's assume I have both demand and supply, and I'm anticipating or expecting that expiry is just around the corner, and until expiry prices might remain within this range. So I want to plan a non-directional trade, right? So again, you can see it is first starting as where are my demand areas, where are my supply areas, and then based on that, I'm making my decision what kind of trade I want to take. And now even when you're trying to plan an options trade, we also have an options course which is 100% free. So again, when you'll go to our website under courses, you'll be able to find the options course as well. You can see the last one is your options trading. You can go through that course to understand how to plan option trades more efficiently. So yes, all these courses are 100% free courses. So that basically covers today's session. Again, thank you everyone for joining in. I'll see you now next weekend. Till then, fit safe. Enjoy your Sunday. Take care. Bye-bye.